When day trading, it is very important to have always the second entry, because there will be days and weeks where the market is not moving that much. And especially trading price action, there will be days and weeks where the market is moving more than the others. And you can see here clearly how the market starts to move up just by experience. If you just make the chart together, you can see how it just like rotates higher. You can see obviously that the market does more green than red candles. You can see that the market does more moves in length up than down is very important, especially until here. You saw here a couple of rotations already. That means that the market was going back and forward, that the market provided you a picture with all those things that I told you. And you can see how the market starts higher, making more candles here than down here. That means the market wants to trade higher because it's accepted by time and volume, because the chart always persists out of volume, time, and price. So here you can see, and this is something what I think is very important, when we have a $3,000 or $5,000 account, first that is a demo account, please, to adjust $100 a trade using enough leverage trading futures. That is to use the 1 minute chart and to trade always the color switch. That means a red and a green candle that is tiny, as you can see here and here, to enter after the green candle closes, and the stop placement under the color switch. What the trader did here, the trader used a very small stop placement, something what I really love, because when having enough leverage and entering here to trade what I'm drawing and having the stop placement down here, losing $100, but when entering the trade again and having enough leverage and keeping the stop so tight as you see here, this can be here a $700, $900, or even a $1,200 trade just within 7 minutes. Of course, that can go in the other direction. But for that, we have a stop loss adjusted to $100 in average. And of course, what is very important, we have also a rule that says after the second losing trade in a row for the first 2 trades, we need to stop. But if one of these trades are working, then we should have around $300, $500, $800, depends on where the market is running at. And usually the market will aim for bigger structure highs, as you can see here, or go here very nearby. In this case, the market was even touching it, as you see up here. But of course, when having so much leverage, it is more about adjusting $100, getting $500 to squeeze in and to exit so good as possible for our money management. There will be times, and this is something what I had, and I posted also a video about it. I think it was like 5 videos before this. It was about a trader who didn't do the second entry. The trader was more reading that the market was pressuring in one direction, and then first entering the trade while the market was already touching a high, as you can see up here. But this is where trade quality is decreasing by 5 or even 10 times, what is insane, because market pressure is already gone. The market is aiming usually for bigger structure highs and bigger structure lows. And when you use a 1 minute chart, we have 60 candles within 1 hour. It's important not to trade every green or red candle. It's important to trade color switches to decrease the trading opportunities, because when doing so, I just saw from a beginner and she had 50 trading opportunities by trading 3 times, 4 times a week just for 2 hours in average, just this one single market, the S&P 500 future. And the thing is that when you see that currently, today, in your trading session, there are more green than red candles, the market is structuring higher, there is more length up than length down while the market was rotating multiple times until here, as you see here, right? Then the thing is, you don't want just to enter just once the trade gets stopped out and wait for another 2 weeks or 3 weeks sometimes. It's literally to use, I think, the whole daily money, what we have in our daily money management. That means in this case, what I really love for a rule is $100, around $100 adjusted a trade. Sometimes it's 75, sometimes it's 125. And also that we have a 2 stop rule. I front tested, I tried out with many students that was to adjust it to $200 a trade. But the problem is when adjusting just to $200 a trade, the trader might place the 4th, the 5th, the 6th trade. And just to try to squeeze in futures trading this $35 trade. And I think that's not good. I think it's very good, very important to have clear criteria for each trade that the trader can build a clear trading performance. What is very important is, as you can see here, this is what we will do in another video, is that how the trader lost 3 trades, how the trader had 1 single winning trade. Each trade was around $100, as you see here, but the winning trade was $560. And this was the main reason why the trader made for this week $260. So it's about the money management and the risk reward ratio. So the trader could sometimes, and this is something what's very important, if the trader would have a second time a winning trade of $500, this would be $760 front. That means the trader can now allow himself 7 more losing trades and still be okay. And this is something what's very important. There is this delusion always to have more winning than losing trades. While a beginner who never traded yet for 1 or 2 years consistent with real money, I think it's something what is absolutely normal to have more losing than winning trades. And this is what makes the risk-reward ratio so important. And of course, a good trading strategy where you have clear structure.